Okay, good morning. Let's get right into the stock market technical analysis. We're going to look at the broad market indices using technical analysis to tell us where the markets are likely going to go. So if you're new to the channel, follow along, pay attention, and hopefully you learn a couple things. I've also put together a technical analysis course, priced it at $99, so it's affordable to all. I've heard really good positive feedback on that course, and that's about 4 to 5 hours of video training. So check that out if you're interested. Let's get into it. Triple Qs, all right, this is our tech sector. A couple things I'm watching at least today. I'm watching that XLF and that 37 level. I haven't checked that recently. Let's jump over there real quick and check that. See, we're just hovering right there at 37. You can see we're at 37.15, and this is the battle level right here on XLF. It's just a key level. I've got all these little reactions circled. And it's basically just a key level that they're really trying to hold. So we'll see where we end up. Yesterday closed above 37. The day before, let me just kind of zero these things out. You can see 37 we held. Tested it again, we held. Yesterday we were below it. They popped it above. Today, battling with it again. So we're still there. We need to see that level go. If that breaks, we're likely going to start to see the S&P 500 break and some of these other sectors. But until that goes, no dice. Moving on to triple Qs. So this is the one area where I think we can continue to sell off. Looking at the hourly, so we have this gap to fill. And a couple of people asked me yesterday, there's two gaps to fill. I don't think we're going to fill this upper gap right up here at 359. It's about 360. Of course, it's completely possible that we do, but I'm not so sure if we do. If we do, I really do believe that's probably the end of whatever kind of move that we saw or whatever kind of short-term rally that we get. But if we don't get it today, and that's a long ways away from where we're at, then I just don't think we're going to. This other gap right here is about 348.50, and you can see we had two attempts to fill it right here, failed, and then just today they made it, almost ran up and filled it, but didn't quite get there, and it was rejected again. So in general, when you're in a bearish trend, and clearly we are in a bearish trend, at least in the medium term, gaps oftentimes won't get filled. All right, they'll get filled eventually, but we might not see these gaps get filled for a while. We might head lower. So I'm more open to just sitting tight. I did lighten up on some of my short positions yesterday, and I was looking to kind of add those back. And honestly, just on this gap fill at 348, as we rallied into there and I saw we couldn't quite get there, I just added back my shorts. So right now I'm just kind of fully short in the triple Qs position, looking for lower prices. All right, the key level going to the daily, we need to take out the lows down here, 318.50. All right, that is a key level of support. So, I think we're going to work our way down there, to be honest. But, whether we take that out or not, we're going to have to wait till we get down there. If that goes and we break through that, we should see probably waterfall selling showing up and a drop to our next level of about 300. Small caps, this is another key one I'm looking at. Now, this one did gap fill. I'm here on the hourly chart here, and you can see this one only had a single gap. And the gap was right here at 202.55. And you can see today they popped it up pretty much first thing this morning, right at that level. And that's a gap fill right there. So I reshorted that thing because I did lighten up on that one yesterday. And as it rallied into that gap, I added back my short. So again, I don't try to point out these little tiny zigs and zags on my channel because things move too fast. It's just not helpful for you guys to get analysis where by the time I get it out there, it's probably already moved. So that's why I really try to focus on the bigger picture and the bigger trend. So on the daily chart here, bigger picture, big sideways topping pattern for over a year. Broke the key level of support at 208.64, 209 roughly. Rejected once, rejected twice, little brief pop above it, and a firm rejection again. Nice big impulsive selling there. So again, as far as I can tell, we are going down here, and then this will be our key level, our next, big test. This is where they're really going to try to fight the bulls. I think it'll break this next time, but it's hard to say. But 180, 188. All right, if we break that, then we should head straight down to about 174 to 170. That's our next level of support. down there. So looking for more downside a bit longer term. All right. And the little zigs and zags, you know, if you see gaps and you're an active trader, you know, you can try to game those. Those are always possible. And I try to do that a little bit. But for this channel, I really try to cover kind of the larger trends. Gold. All right. So gold is just kind of hanging in there. We've got some support now at 1960. So you can see here on the daily chart, we held this as resistance and now we're above it. And it is holding a support. Now it's not taking off, but we are holding above it, you know, so we'll see where we end the week. You know, if you go to the weekly chart, that's going to be important. You're going to want to see a weekly breakout. Ideally, you know, gold rallies strong into the close, into the end of the week on Friday. And we've got that weekly breakout. All right, so gold's still hanging in there, looks relatively strong, and it's supportive. So looking at that, and then the miners here, GDX, still holding above, still have those negative divergences. So, you know, if we look at the RSI, and here's the PPO, you can see we're just starting to make that bullish crossover right there. See that bullish crossover? So again, on the PPO, you've got a negative divergence where you have a downward trend in the momentum, all right, on the RSI and the PPO, and an upward trend in price. That's negative divergence, but getting a little bit of a mixed signal here because we're seeing this bullish crossover right here on the PPO as well. So we'll see, you know, if something's really going to be bullish, it can and will burn through the negative divergence and continue higher, and there will no longer be negative divergence as price continues to explode to the upside. I'm leaning that way, but you know, just with the sign, we're really far off of a potential backtest of the 200-day moving average. We're starting to get that bullish crossover on the PPO. I'm seeing signs of bullishness, even though we have that divergence. Again, divergence is not a reason to just exit a trade either. It's just merely conditions, all right? The conditions are there that we could get a correction or a pullback from where we're at, but it doesn't mean we have to, because if we continue strong and looking bullish, we burn through the divergence and off to the races we go. So, okay, semiconductors, SOXX. Again, bearish rising wedge pattern right here. This is the bigger picture stuff. We broke to the upside of the bearish rising wedge. That's not normal, but it happens quite often. But there's a high probability when you do that, you're going to break to the downside, especially if you have negative divergence. And the negative divergence, it really existed right here. So you can see as we broke out and made new highs, the momentum was moving lower right there. That was a signal that the conditions were very strong that this breakout in the semis was going to fail. Sure enough, it did. And then we've, you know, from what I can tell, we're downtrending from here. You can see highs, lower high, slightly lower high, and then you got the lows, and you're making a low and a slightly lower low. So we're downtrending right now. It's not a super obvious downtrend because it's just a very slight downtrend. But again, that's typically how bear markets start. You know, they'll start with mild, slight downtrends, and they become more intense and steeper as more and more people realize that there is a downtrend in play. So looking at SOSX, kind of consolidating under what looks to be some resistance at 435.50. I'm looking for lower prices here, down to 387.55, 383. That's a zone right there. Okay, short trade idea from yesterday, ABBV. We got a sell signal yesterday, so we're still on that sell signal. I'm looking to probably add a little to my short position on this kickback rally today. Here's ABBV's been very strong. I mean, the thing from, you know, really from December, this time it's up 50% in a couple months. So this is where all the retail people are hiding out. I hear Kramer talking about going to healthcare stocks, you know, so lots of, you know, and even the institutions, but this is where everyone's hiding out. This and the Fang stocks. And we need to see some weakness here. Without the healthcare stocks breaking, you're not going to have the S&P 500 break for the most part. But uptrend line here on ABBV at the top, we put in negative divergence. It's just slight negative divergence. It's not a huge divergence. If I roll in, you can see the RSI just, it's kind of an equal high. And then the PPO is just ever so slight negative divergence right there. But the key is we got a big breakdown sell signal yesterday, and today we're just getting a back test. So I suspect that this rally today will not recover the support line. It might, but I would say the probability is that it doesn't recover that support line, and it's actually going to act as resistance, and will likely get rejected off of there and start to head lower down to our next target, which I see right now as about 150.85. All right, that's the first target. Second target I've got at 138.08, and then obviously you have the 200-day moving average down below. So that's what I'm looking for. I'll probably add a little bit if it wants to rally into this resistance line, then I'll look to add about 164.50, add a little bit, and continue to build a short position on rallies. So because of that sell signal, this to me is sell the rip, and there's a rip right there. So looking to add to that. Moving on. And a quick look at the Fang stocks. They all look weak today. Apple, you can see selling down, yesterday's gains being pretty much erased. I think we're heading lower on this one. We're likely heading down to the 200-day moving average. Going to battle there for a little bit. There will be buyers there at the 200, almost guaranteed. It's just the algorithms are programmed to buy at the 200, especially for Apple. So doesn't mean that it's going to be a bounce to new highs, but they'll definitely try to defend that. So likely going to see some chop down there. Microsoft selling down. Microsoft's got some support right here. It's basically right where we're at, which is about 282.70. A break of that, we should head down to the next level support, which is about 263.72. So I see lower prices there. Google selling down, just as far as I can tell, just everything looks like it's kind of topping out. We've topped out, and we're going to start a downtrend. So we just need that final kind of push over the edge. We need to take out the lows here, the recent lows, probably right here at about 2,500. We'll call it. You take that out, you're likely heading a lot lower. Amazon, again, on the weekly chart on Amazon, rolling back to 2008, the Great Recession. You've got weekly support. That's a trend. That's your bull trend in Amazon. As I roll in, you can see we had a big break and sell signal, and it's just been this big chop zone recently, but very likely that this resolves to the downside. You can see we had the sell signal, we bounced up, we were rejected. We bounced back up, we were rejected. So that's two rejections of that major trendline resistance, and we just need now the prices to start to resolve to the downside. All right, I don't see any real major support once we get through this big chop zone here till we're down to about 2040-ish. Good support down there. So I think that's the likely target on Amazon, and if Amazon does that, I would expect Qs to be rolling over and some of these other ones. There's no way Amazon's going to get down here without the other stocks rolling over, the other Fang stocks rolling over as well. Okay, let's look at bonds. We're going to go to the daily chart here. You can see more selling in bonds. This is not good. This means interest rates are rising, and they're rising pretty quickly. Anytime you have interest rates rising at a fast rate, then you have an opportunity it's elevated that we might get a market crash, a swift move down in stock. So keep an eye on these bonds. This is TLT, the inverse, or if you want to look at the interest rate, you can look at TNX. This is our 10-year. So you can see we're reaching a new high here in the 10-year interest rate. And for the most part, financial instruments are built off the 10-year. You got mortgages and credit card rates, auto loans, student loans, a lot of that stuff's built off this 10-year rate. And so we're seeing the 10-year continuing to rise. That's going to continue to put pressure on interest rate sensitive sectors and markets. So one thing to note on TNX, and looking at the weekly chart, so if you roll out, this is your long-term forward. We're in really strange times because we're kind of at the end of what looks to be a long-term trend that has lasted 40 years. And so going back a lot of videos ago, I talked about how basically the people that are alive today for the most part, have only, at least for their investment lives, when they're in their 20s, 30s till now, baby boomers, millennials, have only known falling interest rates. And so you get this thing where the financial advisors, a lot of them are, in their 30s or 40s or whatever, they basically say they say invest for the long term because stocks always go up. And that is, for the most part, going to be true but it's not because of what you think. It's because the dollar continues to be devalued over time. All right, the dollar, since the Fed took over, has been devaluing the dollar since, for 100 years or so. So the market being priced in dollars will continue to rise over time. However, since about 1980s, there has only been, every single time you have a recession or a correction, the Fed has been there to cut interest rates, and they've done that for 40 years. So here's the interest rates. Every single time you have a recession, the Fed has dropped interest rates, and they really got pretty much extreme back in the COVID drop, and this is why we're seeing massive inflation. So now there's crazy inflation going on, and the Fed has only a 1/4 point interest rate right now, so there's no interest rates. And so when I go to something like the SPX, and we look at, if we go back and look at the time frame, you can see that, basically the Fed started dropping interest rates back in the 80s. And look, prior to the 80s, you're in 1960 all the way to about 80s. This is where Greenspan, when we started to have any kind of recession, started dropping the rate. So you drop, and then they basically have created this rally over the last 40 years. All right, this is when the Fed started dropping rates every single time there was a recession. All right, prior to that, you see for the prior 10 years before that, markets really went nowhere, and you had several big bear markets. I know these don't look like a lot, but look, from the high to the low here, that's a 35% drop. It just kept getting bigger and bigger, and then there's a new high to the new low, 50% drop. And all the while, so if you were investing over the long term from 65 till about 80, so about 15 years, you had to ride out several big bear markets, and inflation was running extremely hot for a big chunk of that time frame. So basically, at the end of the 15-year period, your stocks nominally had really gone nowhere, and in real purchasing power, due to the inflation, you'd lost about 40 to 50% of the value of what those stocks were. So, and then the Fed created this. So, are we going to repeat something like this? Are we going to have something that's even worse? The point that I'm trying to make is markets don't always just go right back up. They've only done that over the last 40 years because the Fed's been in there cutting interest rates. All right. So to say that, markets always go up over the long term is a perspective that people that are alive today have. It's a fallacy, essentially. It is not true, but for the people that are alive, their investment lives, it is true for their investment lives. That's all they've seen. So they have I don't know what the bias is called, recency bias. It's basically, this is all they've known, so this has to be true, which is not, that's a fallacy, right? If, markets don't always go right back up. You look at the Nikkei, and you'll notice that their market crashed, I think, in the late 80s, and it's never came back, all right? So it's more of an American bias, and it doesn't necessarily mean it's true. So we could see prices come down, and they might not go back up for 15 or 20 years, all right? Or who knows how long. Okay, TSM, you can see down 2.5% today. Again, looking for lower prices. Yesterday, they rallied it up a little bit. Today, gapped up, and it's just been selling ever since. So looking for, I don't see any reason why this is not going to continue lower. My next target, we've got a little gap to fill here at 93.60, so probably going to get a minor reaction there. Good support down here at 76.85. And yeah, those are the next two levels. So just to wrap everything up, longer term, I still see tech selling off, looking to sell the rips in tech and small caps, looking to buy the dips in gold and gold miners, looking to buy the dips in commodities, commodity-based commodity-based things. But again, not, I'm looking to buy the dips there. Those have run pretty good. So we get some sort of a correction, which is what I think the Fed is trying to engineer, is a soft landing. And I've talked about that. They're trying to walk the market down. They don't want the market to crash, but they want it to come down to ease some of the inflationary pressure. Likely, they're going to not want to ease all the inflationary pressure, but they're going to try to at least change the trend a little bit, so we have maybe inflation come off a little bit. So instead of rising and continuing to get worse and worse, maybe it gets a little bit better, and then they can say, oh, look at that, we peaked out, inflation peaked out, and everything, we're going back to normal, and that will buy them some time, even though I don't think the inflation, they're going to be able to kill that inflation. I think they will. It's going to continue to run. So we just look to buy the dips in the inflation trade. We look to sell the rips in the speculative kind of tech trade. Until I see something different, that's how I'm going to play it, bigger picture. So, okay, guys, thanks. Drop me a thumbs up, and I'll catch you.